Good morning. We will pay attention to the effect of debtors' allowances on the cost of sales when trade discount was not taken into account. Any deduction on the account of a debtor is always recorded in the debtors' allowances journal, and when you reduce the debtors, you must always determine if it will have an effect on cost of sales. The only exception on the rule is when a debtor pays his account and discount is allowed because he paid in time, this entry will be recorded in the cash receipts journal. Leaf traders agreed to allow 10% trade discount to Moller traders. Moller traders complained because the bookkeeper issued the invoice for $500 without subtracting the trade discount. We have to correct this mistake. Leaf traders maintains a profit of 25% on cost price. So when the goods were sold, the debtors control was debited with the full amount of $500, and we increased the income for sales with $500. That's actually supposed to be lower. Then on this amount, we calculated the cost price and we increased cost of sales on the debit side, and we credit the asset for inventory on the credit side with $400. This $400 is our cost price, irrespective of what we allow discount to a debtor. We will not reduce the cost of sales because our supplier will not give us discount because we allow trade discount to our customers. So in this case, we will debit debtors' allowances to decrease that original income out of sales to show that actually the income is R450. And the debtors' control account will be credited so that we can reduce his debt to $450. In the accounting equation, debtors is debited to increase assets with $500. Sales is credited to increase profits with $500. An invoice is issued and we record it in the debtors journal. Then we will do the second entry when we sell goods. It's always a double entry for sales price and then a double entry for cost price. So cost of sales is debited because expenses decrease equity. Inventory is credited to decrease assets. When we allow the discount, debtors' allowances is debited to decrease the profit with R50 so that we can cancel out that R500 income and reduce it with R50. Debtors' control will decrease the assets, and we will issue a credit note to the debtor as proof that we will reduce his account, and we record it in the debtors' allowances journal. When the account of a debtor is reduced, the debtors' allowances account must be debited to decrease the income with the sales price, and debtors' control is credited to decrease the outstanding debt with the sales price. We always have to determine whether this debtors' allowances will have an effect on cost of sales. If the cost of sales must be reduced, inventory is debited and cost of sales will be credited.